This video is for entertainment, educational, and informational purpose only. Always contact a financial advisor for investment help. Hit the subscribe button and the bell notification so you don't miss any of our videos.
Imagine waking up on a Monday morning. No alarm screaming at you. No boss expecting you in the office. No soul-crushing commute through traffic. Instead, your phone buzzes. You pick it up and see a notification from your brokerage app. Dividend payment received. That's not a bonus. That's not a gift. That's your investments paying you just like a paycheck. Except you didn't have to work for it this month. Welcome back to the channel. I am Will, a team member here at Doug the Retirement Guy Monthly ETFs. Today, Doug will break down the portfolio strategies for you. Welcome, Doug the Retirement Guy, with a 4 ETF portfolio for stable income.
Hey, thanks, Will. So we have 4 ETFs that pay you monthly. We're going to rank them by total return. We're trying to establish a portfolio that gives you a stable monthly income that you can count on. So we rank them by performance, not just by yield. So our whole goal here is not to take the highest possible yield fund and give it to you some big numbers. But what we want is deliver monthly cash flow focused on the 24-25 total return. So we're preparing for 2026. So we can just give you guys a great idea of what to do and move forward. So before we get into that, I just got to put a big shout out. If become one of our subscribers, man, we are rocketing. We are trying to get to that next level. Don't be afraid to hit that subscribe button. Don't be afraid to hit that bell notification. It's real simple, easy to do. Let's get into the rest of the video. The first fund that we're going to use is NEO's S&P 500 High Income ETF, SPYI. Now, I know I've talked about this on the channel before, but this is a fund, and I really enjoy this fund. There's a reason for it. It's an exchange fund that mostly invests in large cap equities. The fund aims for tax efficiency and high monthly income by actively seeking stocks and options on the S&P 500. Now, this fund came out August 30th of 2022, so it's got some time under its belt, and it's really shown that it's got some strong performances. If you look down here, you'll see 15.16 total return with a 11.99% yield. So that's going to give you some strong income. It's built on the S&P 500 with covered call overlay, and it's really anchored for stability, not speculation. This thing it really holds for that stability that you look for in a retirement account. The pros: has strong returns, has a very tax efficient program dialed into it, steady income. The only con that I can really give you on the S&PY is its capped upside. So you can see already that the total return versus the yield, okay, we're probably in a 4%, probably a little bit less than 4, about 3.7%. So you can see that you're not going to grow your money big time, but you're not going to have a worry about losing it as well. So when we take a look at this, we look at the fund. It matches the S&P 500 basically by the categories: the technology, the financials, the consumer discretion, healthcare, communication services. That is very dialed into exactly what S&P 500 does. Now, S&P 500 gives you some nice, steady, hard growth, which we all talk about and we all know about, but you don't get the income. So this is doing the absolute opposite. It's trying to give you the income with a little bit of growth. When we look at the performance over the period of time, just 1 month, the thing's up 3.52%. Year to date, up 13%. 1 year, it's 16.26%. Max, 14.65. So your total yields are all here. Okay, now these things are going to include your dividends and your return of the value of the fund. So everything is solid across the board with a very secure fund. When we break it down a little farther, there we go. The growth yield, 3.17. Even with the April 2nd, even with the stuff that's happened after that, this thing still continues to crank out to give you a 3.17% growth year to date. So very solid across the board. When we look at the dividend, that 11.99% return, look at the number up there. You are bouncing basically this year alone, you're pretty much bouncing, I'm going to call it 50 cents and above. Okay, it's primarily been at above 52 cents for the entire year, other than the one little drop off. You guessed it, and that was April. But overall, it comes right back 52 cents across the board. So it's a steady cash flow each and every month that you really don't have to worry about. Our second fund is going to be the JP Morgan NASDAQ Equity Premium Income ETF JEPQ. Now, again, we've talked about this fund before. This one is very well recognized out in the marketplace. It's pretty much been called the leader in most markets. And it does the NASDAQ 100. Now, the difference in this fund here, it is an exchange traded fund. It does invest in the large cap equities. It does all the U.S. companies. Okay, that's a big factor right there. This one is all dialed for U.S. JP Morgan has done a great job. It came out in May of 2022. So again, has some time under its belt. We can see what's going on with it. It's designed to generate income. When we look at the highlights, your total return of 16.48% total return with a 10.43% yield. So that means you're going to get a solid 10% return for income with about a 6% growth of the fund. Now, it's built around NASDAQ's growth stocks, which is going to be heavy technology, Apple, Microsoft, Nvidia, Meta. It's structured and actively managed cover call strategy. Okay, the pros, it's the growth and the yield. You're getting both of this one. You're getting a nice growth package, about 6%, and you're getting a nice yield, about 10%, to give you that total 16.48%. Low volatility. Okay, so your fund's not going to be going up, down, sideways, every which way. Plus, it has very low fees. That means you put more of your money to work into the fund. Now, the cons on this, they said, is ordinary income tax. It has a limited upside because of the covered calls, and it's the complex notes. So what they're really talking about is it is complex that none of us could. I mean, you got to be a professional to be able to go out there and sell the notes and do everything that needs to be done to generate that income. And the limited upside is with the covered calls. Now, ordinary income tax. Now, what they're saying is that they're producing the dividends that are coming out are ordinary income tax. So you're going to pay standard income tax onto it. But I also looked into it deeper and found that they do use a tax advantage of a 1259, I believe it is, program, which is basically a 60-40 split. So 40% of them are going to come to you as ordinary income tax, but the other 60% is actually going to be classified in the capital gains area. So it helps reduce your taxes overall. When we look at the breakdown again on theirs, they're heavy into technology, over 43%, and then others 21.81%. So they have a lot of little things that they've picked up in because they're trying to find anything that can generate solid income. The consumer discretionary and communication services make up their next two. When we look at their performance, just 1 month, 5.15, year to date, 10.47, 1 year, 18.35, inception, 16.18. So again, another one with solid core numbers. So you can't really argue the first number one and number two are almost identical, one using the S&P 500, one using the NASDAQ. Now we take a total look at the growth. You got a growth of 6.05%, and you're going to see this on every one of the charts. April, everything dropped down to rock bottoms. Okay, and then it came back to a second round, did it again. It's how it's come out of those two markets is what you can see if a fund is done well or it's done okay, if it's done horrible. And here the JPEQ has done well. It has not gotten back up to the level that it once was earlier in the year, but it's recovered from the losses that it had to give you a 6.05% for the 1 year. We take a look at the dividends, 10.43 dividend yield. We look at the chart. Again, consistency It's consistency. Yes, anytime you have covered call options, you are going to have some, I'll call it flexibility. Okay, you're going to have some spikes, down spikes. It's all done by volatility. But what you want to look at is what's the bottom one, what's the top one, and how was the gap between those two. So when we take a look at it just in 25, that thing's been basically at 44 cents to a maximum of 62 cents. But majority of your stuff is at the 44 cents. So it's a very smooth bonus. You don't have anything well below that. When you go back to 24, you see the thing was about 35 cents to a peak of about 55 cents. Okay, again, most of it down in that 44-cent range. So even if you with the spikes all the way through, you may have one drop here and then one go high. It's very balanced around 44 cents. Number 3. Now this one took us a little bit more research for us to really dig into this one, because we just were looking and we're like, this thing keeps popping up on our desk. And it's the Goldman Sachs NASDAQ 100 Premium Income ETF. Now, exchange trade fund that mostly invests in large cap equities. Okay, it does it with the NASDAQ 100. So it combines the equity investments with a call strategy, and the fund generates a stable income while offering the potential capital growth. And this one came out in October of 2023, so it's a little bit newer. Not much. We're almost 2 years into it already. But the one thing that we kept coming back to is the Goldman Sachs. What they do, they take someone's strategy and they perfect it. They take someone's strategies and push it to the limit. Okay, they put their twist onto it, what they do the best. So when we come back to this, you have a 20.78% total return with a 9.76 dividend yield. So if you want to do the math real quick on this one, we're talking 11% growth. So this swings dials more into the growth side than it gives you income side. This is why we come back and said, is this strong? Do we want it for dividend? And we kept going back to it. We said, what was total return? Because we need to protect our investment in troubled times, good times. In bad times, you got to watch it all the time of your total investment. So we can't just say, give me big yields, because we need the protection, and that's what this thing gives. They do dynamic call strategy, which is balance for offense and defense, which was another big positive to this. They're watching with covered calls and puts that if something's going down, they're going to jump onto it and sell the puts. If there are things going up, they're going to jump on it and call and do the calls. And then the other thing we ran into, the expense ratio, 0.29%. A very, very low expense ratio. It's kind of lowest in its class. So even though we already have a NASDAQ 100 into it, we have something here that's almost like use it as protective. Low expenses, a balanced fund that gives us offense and defense, gives us nice solid growth with a nice yield. So proactive calls, positive, strong returns, low fees. Okay, the cons of this is lower yield and a bigger tax exposure, and then taxable income, of course. So when we started dialing this into it more, we started seeing it. Well, this NASDAQ 100 has a 52% technology, consumer discretion at 12.96, communications at 12.63. So I said, again, you're going to have a lot of tech no matter what. Tech is where the market's at. But look what they did on the backside. We have over 24, almost 25%, a quarter of the fund in communications and consumer discretion. When we look at the other fund that we just looked at, we didn't have that. We were in an other. So that's why these two fit so well together, in my opinion. Now we take the performance, and it's not just a fluke. This thing's 5.49% growth in 1 month, 16% year to date, 23% in 1 year, 29.43 cents inception. This is a phenomenal package from Goldman Sachs. So I think this one is across the board. You want to have this in your portfolio to protect you for in what I call for growth. So you're going to get some decent growth out of this one with some income across the board. While you have other funds that are generating more income, it doesn't always have the safety net that you're going to need. So when we take a look at this, and this is again, the picture, the bar charts are almost identical. They all have the downward side. They all have the recovery, then they have another down, and then they come back. But this one in 1 year, 11.02% growth. So this one's outperformed. It made up its losses, came right back, and it's actually doing better than it did at the beginning of the year. And then we take a look at the dividends. This is another big one. If you take out the April drop off, okay, this thing was on a steady run up. When we started in January 24, it was 37.5 cents. And then it just continued to climb up to the 40s, then up to the 42.5, and now it's up to 45.8. So we're having a steady recovery. Again, the dividends are not going to be huge. The dividends are not going to come out of this thing rocketing out of it. But what you're getting is a steady flow and a steady growth of your dividend. Our final one is back in the NEOS family, the NASDAQ 100 High Income ETF. I know we have 3 funds in NASDAQ 100. And that is, that's going to be one issue I know people are going to throw back at it. But there's a reason for every one of these being put into the package. Now, this one, I hate to say, is the newest one across the board of January of 2024. So we have gotten just a little, a year and 10 months into this one so far. So when we look at this as we go through, the reason why the NEOS 100 is put in here, this gives you the best of both categories. It gives you a total return of 20.43%. That gives you a yield of 13.55%. So it's just shy of 7% growth in the fund with a huge income of 13.55%. It is focused on the NASDAQ 100 with aggressive call overlay. Okay, these guys do it very, very aggressively. It's built for high income. It's built for the yield. While the last fund was built for security and safety, this one's built for higher returns with a smaller portion for growth. The massive yield, the strong return, and the consistency of the payouts gives it a very, very strong positive mark. Another one that I put in here, and this is the reason why I picked this one, and it is the tax efficiency manner that it grows your fund. Okay, these are using some options that they're using return of capital, which I know freaks people out, but watch the video about what return capital means. It gives them able to kick your tax bill down the road. Okay, so it gives you that you're going to use it to reduce your investment on paper, but then you're paying for those dividends as capital gains long term, so it saves you money across the board. And there's one thing that NEOS does extremely, extremely well. Now the cons, because we're so aggressively doing with the covered calls, we can have some NAV erosion risk. It's a higher volatility. So you're going to see this thing go up, down, up, down, up. You're going to see a lot of movement in the price of the fund, but you remember you're collecting the bigger income. So this is why we have 4 packages. This is why we have 4 different funds. Even though we're using NASDAQ 103 out of the 4, there's a reason and portion for each and every one of them. So when we take a look at this one cranks up. You can see why I said it's a little more aggressive. They go to 51.20% in technology. So over half of their fund is dialed into technology. They also do the communication services and then the consumer discretion. So they've kind of flipped those two, but you're still getting a big portion there. The money is coming out of technology. That's where they're getting the income from. Not saying you're not getting it from the other portions of the portfolio, but this one is the one that you get the volatility with and you get the income with. We take a look at the performance. 5.01%, 15.66 year to date, 23.26 1 year, and 21.29 since inception. Very, very strong numbers because you have a combination. You're looking for income on this one, and your Goldman Sachs, you're looking for security and growth. So when we take a look at it right now, same old thing. April 2nd, drop off, recovery, then recovery again to a 6.88% 1 year growth. We take a look at the dividend, it's 13.55%. So everything's playing above that 60-cent range. And again, you look at that, you always look at the dates. That was April. Had a big chunk in April, dropped off, came right back roaring, and we're back to 64 cents per month on the shares. Very, very solid piece. Now let's take a look at the big picture, yield versus total returns. So when we look at the funds, SPYI, the S&P 500 package, gives you a 15.16% total return yield. And you have an 11.99% Guys, it's Doug the Retirement Guy. Hope you liked the video. Give us that thumbs up. If you're not, hit that subscribe button. And of course, always leave a comment below. And we want to thank each and every one of our Patreon supporters. You guys are phenomenal. Thank you for your support. And if you like this kind of information, check out Patreon. It's free to join. And then if you want, there's stuff behind the scenes for a little bit of fee or a one-on-one with myself. You can get into that. But most of this information is on there, and it's just free of charge. So we'll talk to you later.